Kristin Cooper here, your certified mortgage planning specialist, and today we are going to talk about one of the biggest myths when it comes to gift and gift taxes. And so we're going to go over this a little bit more in detail to make sure that you understand if you're looking to get a gift for a purchase, or if you're talking to someone that wants to gift you the money but they're not really aware of the tax laws. Then share this video and make sure you reach out to your CPA or tax advisor, as I'm not a CPA or tax advisor, to make sure you confirm this information that applies for you. Now, when we look at the gift exclusionary, there is the annual $15,000 exclusion per person, and that's typically what most people will refer to as I can only give $15,000, and that's correct in the annual exclusion. You are allowed to give $15,000 per person per year and not have to pay any gift taxes on it, and the recipient doesn't have to pay any taxes on it as well. Now, let's say that you want a gift or get a gift of $115,000. Now you're thinking that the $100,000 outside of the 15 is probably going to be taxed. Well, there's the lifetime exclusionary for estate tax, which they just increased to $11,180 or $11,180,000, and that again is per person. So if you have two people that are married, mom and dad, then that's going to double. But let's say it's the one person at the $11,180,000. Well, if you're going to gift $115,000, the $15,000 goes into the annual. And then the additional 100 is just going to come from the lifetime exclusionary. So again, if you have $11,180,000 as your total exclusionary, and we give to $115,000, we're going to take that $15,000 under the annual. The additional $100,000 is going to be a gift tax exclusion, and then it's going to come from the estate tax exclusion of the $11,180. So that means that you're going to have $11,080 or $11,080,000 that's going to be left in your lifetime exclusionary, but the total between what you already gifted under the gift tax and the remaining estate is going to total the $11,180,000. So you would just let your tax professional know that you're putting it under your lifetime exclusionary tax, and there has to be no relationship required, so you can gift it to anybody. Under the $15,000 is one person per year, but here under this, you don't have to have a relationship, and there's no gift tax to the recipient. So even in the scenario where it's $115,000, neither parties have to pay any taxes because it's under your lifetime exclusionary estate tax. So yes, you have the $15,000 annual, but you do have the lifetime exclusionary. What it means is that when you go and let's say you pass away, the person gifting it passed away, let's say they have under the $11 million left in assets, you're fine. Let's say that they have over $11 million in assets that they're wanting to gift, then under that circumstances, the difference between the $11 million that's left and whatever their estate tax is, then that could be taxable. So reach out to your CPA tax advisor, but when we're considering mortgages and we're looking at mortgage planning, we want to make sure that everyone's aware of tax liability, because there is such a misconception that you can't gift funds. So there is tax-free ways to gift the funds. You just want to make sure you're working with the right tax professional and CPA to go over that information. If you need a referral, please let me know. I work with great CPA and tax professionals that can offer the support and information and guidance that you need. Hope it gave you a little bit more information. If you have any questions, please reach out to me. I'm more than happy to answer the questions that you have. Again, your certified mortgage planning specialist, Kristin Cooper. Have a great day.